One meeting on a private island, a century ago, quietly rewired the global money machine, and you're still paying the price. You feel it when rents rise faster than paychecks, when markets levitate on promises, and when every crisis ends with the same kind of rescue. The game didn't become unfair overnight. It was engineered, refined, and made to look natural. Behind the headlines, the rules were written to protect the system's core no matter the cost to everyone else. Welcome to Hidden Finance, where we untangle the stories money doesn't want told and decode how power flows through the global economy. Today, we trace how the financial architecture was tilted more than 100 years ago, how it evolved through wars and booms and crashes, and why it now points toward a digital future most people aren't ready for. This isn't about villains in smoke-filled rooms. It's about incentives, structures, and a design that keeps repeating. If you've ever sensed that the board is slanted, you weren't imagining it. Let's step into the rooms where the rules took shape. At the dawn of the 20th century, America's money was gold, credit was scarce, and panic came with the seasons. The country was industrializing at breakneck speed, but the financial plumbing lagged the pace of railways, steel, and oil. Banks were fragmented, money tended to pile up in New York, and cash dried up every harvest when farmers needed loans the most. On a strict gold standard, the supply of money couldn't breathe with the economy. So small shocks became big ones. Ordinary people carried the cost of that rigidity in job losses and bankruptcies, while large financiers profited from crisis bargains. The Panic of 1907 became the final straw. A run on trusts nearly toppled the financial system, and it took one man, J.P. Morgan, locking bankers in his library to coordinate a private bailout. Clearinghouse certificates replaced cash, reformers cried foul at the money trust, and Congress launched the Pujo Committee to investigate. The message was clear: a system this vital could not depend on a single financier's midnight intervention. But what should replace it, and who would control it? Across the Atlantic, central banks in London, Paris, and Berlin had already mastered the art of managing liquidity and defending gold. Great powers financed empires with bills, bonds, and a choreography of gold shipments that looked like clockwork until it didn't. The United States wanted that stability without becoming Europe's servant, and Wall Street wanted a lender of last resort without losing its dominance. War clouds over Europe hinted that the old order was fragile, and money, the lifeblood of commerce and conflict, needed new rules. In that liminal space between crisis and reform, design choices would determine winners for generations. In November 1910, a handful of men boarded a train under assumed names and disappeared to a private club on Jekyll Island, off the coast of Georgia. Senator Nelson Aldrich, together with bankers and a future central banker, drafted a plan for an American central bank in secrecy so complete that even the waiters didn't know their guests' identities. They proposed a system elastic enough to stop panics and sophisticated enough to serve a modern economy. But the draft also reflected its authors: a central bank structurally close to the banks it would oversee, designed to stabilize finance while keeping the levers within reach. It wasn't a conspiracy, it was an alignment of interests hardened into architecture. By 1913, after political pushback, the Federal Reserve Act emerged as a compromise, a public-private hybrid that still defines American money. 12 regional reserve banks were owned by member banks, overseen by a public board in Washington, with the power to issue currency and lend against collateral in emergencies. The promise was a currency that could expand and contract with the needs of trade, and a lender of last resort to reduce the costs of panic. But discretion had entered the system. Money would now be supplied not only by gold, but by decisions made by committees behind closed doors. That discretion would prove stabilizing at times and deeply unequal at others. World War I arrived, and the infant Fed learned its first lesson: money is national security. To finance the war, the Fed supported Treasury bond sales, underwrote credit, and helped expand the money supply. Gold streamed into the United States, the nation pivoted from debtor to creditor, and Wall Street's influence climbed. The war pushed prices higher and power closer to the center. The marriage of state and finance deepened, and separating them again would be hard. The emergency levers, once installed, were too useful to give back. The 1920s became a laboratory for modern credit. Consumer loans put cars in garages and radios on mantles, and open market operations became a new tool to steer money and markets. Policymakers tried to cool speculation late in the decade, but margin debt exploded anyway as brokers financed a frenzy. When the bubble broke in 1929, equity prices imploded, banks failed by the thousands, and the money supply collapsed. The machine was elastic in theory, frozen in practice. From 1930 to 1933, the Fed hesitated to use its full powers, guided by a doctrine that favored real bills over aggressive rescues. Bank runs cascaded town by town, credit evaporated, and unemployment soared. Franklin Roosevelt declared a national bank holiday, separated commercial from investment banking, insured deposits, and rebuilt trust brick by brick. The system had averted collapse, but only after the social fabric tore. Stability, it turned out, required more than rules. It required winners not to consume the board. Then came a decision that few today remember but all still feel. In 1933, Americans were ordered to hand their gold to the government at a fixed price, and in 1930 the official price of gold was raised from $20.67 to $35 an ounce. Overnight, the dollar was devalued by about 41% against gold, transferring purchasing power to the state and debtors while savers bore the cost. The monetary base swelled, and the government gained latitude to fight the depression. The lesson was stark: when pressure peaks, the rules can be changed from above, and private wealth becomes public policy. After World War II, the pen remade the map of money again. At Bretton Woods in 1944, nations tied their currencies to the US dollar, and the dollar was tied to gold at $35. Cementing American leadership, capital controls policed flows, the IMF and World Bank were born, and the Marshall Plan rebuilt shattered economies. In 1951, the Treasury-Fed Accord restored the Fed's independence from pegging bond yields, opening the era of modern monetary policy. It was a stable system until the math of promises began to strain. By the late 1950s, the US faced the Triffin dilemma. To supply the world with dollars, it had to run deficits that would eventually undermine trust in the dollar's gold peg. The euro-dollar market blossomed offshore, away from regulators, creating a shadow pull of dollar credit that magnified leverage. To defend the $35 peg, central banks formed the London Gold Pool in the 1960s, selling gold to cap its price, but the tide was turning. In 1968, the pool broke under speculative pressure, and a two-tier gold market emerged: official and private, a split system signaling the limits of control. The promises written in 1944 were running out of room. In 1971, President Nixon ended the dollar's convertibility to gold, declaring it temporary in language that became permanent. By 1973, major currencies floated, prices surged, and the 1970s introduced a new villain: stagflation. Oil shocks multiplied the pain, and a quiet deal with key producers helped keep oil priced in dollars and surpluses recycled into US assets, reinforcing the petrodollar system. Money had become pure policy, anchored by nothing but credibility and power. The gold anchor was gone. Discretion was now everything. Paul Volcker's brutal rate hikes from 1979 to 1980 to broke inflation and reset the terms of monetary authority. But the medicine came with side effects. Waves of debt distress, including the savings and loan crisis at home, meant a sovereign debt crisis abroad. Deregulation loosened constraints, securitization took off, and derivatives offered both hedges and hidden risks. The system grew more complex and more dependent on central bank backstops. Every cure bred its next condition. By 1987, when markets crashed in a single day, the Federal Reserve stepped in with firm words and ample liquidity, signals that became known as the Greenspan put. The 1990s layered on deeper integration. Capital could travel at light speed, big banks could do more things under one roof, and risk models promised safety in numbers. The Asian financial crisis in 1997 and the near collapse of long-term capital management in 1998 exposed how leverage and correlation can snap all at once. Still, the response was familiar: organized rescues, cut rates, pledged steadiness. The message settled in: downside risk would be contained. The 2008 crisis stripped away the veneer. Mortgage securities imploded, global funding markets froze, and institutions deemed too big to fail were saved by extraordinary interventions. Policymakers guaranteed money market funds, backstopped banks, and expanded central bank balance sheets into the trillions. Zero rates and quantitative easing lifted asset prices, even as wages lagged, and the winners looked eerily familiar. In parallel, investigations revealed that key benchmarks like LIBOR had been manipulated, leading to multi-billion-dollar fines and a new cynicism about the neutrality of the system. Stabilization worked, but it came with a price tag measured in trust. Then came the pandemic, and the fusion of fiscal and monetary power reached a new level. Central banks bought corporate bonds and even junk-rated debt via special vehicles, governments mailed checks, and liquidity flooded every corner of markets. In 2023, when regional banks faltered as rates rose, authorities created facilities to lend at the par value of underwater bonds and guarantee depositors above legal limits. Inflation spiked for the first time in decades, quietly transferring value from savers to borrowers and governments. Once again, the architecture bent to prevent collapse, and once again the bill went to those farthest from the spigot. What did the last century really build? A system that can conjure trillions to defend its core, yet often hesitates to support households until damage is done. A framework where those nearest to money creation, the largest banks, the government, and asset owners, tend to benefit first from policy shifts, a dynamic economist called the Cantillon Effect, a pattern of socializing losses in crisis and privatizing gains in calm, widening the gap between paper wealth and lived reality, and a culture of permanent emergency that normalizes extraordinary measures. The rigging is structural, not theatrical. Globally, the dollar's dominance has been a double-edged sword. It offers a safe harbor in deep markets, but it also exports U.S. monetary swings to countries that borrow in dollars and earn in local currencies. When the Fed eases, capital floods into emerging markets. When it tightens, the tide rips out, leaving crises in its wake. Commodity prices, debt costs, and exchange rates move to rhythms set in Washington and Manhattan, often indifferent to local needs. The world has prospered under this umbrella and suffered under its storms. Now, a new frontier is taking shape in code. Central bank digital currencies promise faster payments and programmable features, but raise questions about privacy, control, and the granularity of monetary policy. Stablecoins and tokenized assets are rebuilding pipes outside the old gates, creating parallel rails for dollar liquidity and settlement. Bitcoin and other scarce digital assets offer an alternative reserve that no committee can change, while their volatility makes them more political idea than daily money for now. The architecture is being rebuilt in layers, and each layer carries a vision for who holds the switch. At the same time, geopolitics is pushing toward plurality. Sanctions have turned payment networks into instruments of statecraft, prompting some nations to seek alternatives. Central banks have been buying gold at the fastest pace in decades, and cross-border settlement experiments in non-dollar currencies are accelerating. None of this topples the dollar tomorrow, but it chips at the certainty that one money can rule them all. The future looks less like a single tower and more like a skyline, messy, competitive, and hard to police. We are also living through the late stages of a long debt cycle. Aging populations, rising entitlement costs. History suggests these cycles end with some mix of financial repression, inflation, and institutional redesign. Quiet taxes paid over time, punctuated by decisive resets. The choice is not whether change comes, but whether it is shaped deliberately or forced by crisis. And once again, those choices will decide who gains and who absorbs the shock. What path lies ahead? One direction centralizes money in programmable, trackable forms where policy can target with surgical precision, and where lines between finance and governance blur. Another direction decentralizes through open networks that limit discretion at the cost of volatility and the loss of a single, universal standard. A third path blends the two, with coalitions of states, platforms, and protocols forming a patchwork of monies negotiated in real time. The past tells us the outcome will be written not by slogans, but by incentives, by who benefits under each design. The irony of the last 100 years is that each reform meant to rescue capitalism from its own excess made the system more dependent on rescues. Each rescue concentrated power, narrowed accountability, and taught markets to expect mercy while everyday life absorbed the discipline. It is not a conspiracy. It is a momentum, a long drift toward a money that is policy first and everything else second. That drift can be redirected, but only if citizens understand the machine and demand rules that are transparent, consistent, and fair. This is where history stops being a story and starts being a choice. Thank you for watching Hidden Finance, where we pull back the curtain on the world's most consequential system and the quiet rules that govern it. If this journey sharpened your sense of how money really works, stay with us as we follow the signals old and new across policy rooms, trading floors, and digital ledgers. The past is whispering and the future is already negotiating with it. Listen closely and ask yourself where you want the lever to be when the next reset arrives. This is Hidden Finance. Remember, money isn't neutral. It's a script written by power, and the next chapter is being drafted right now.